Hello, everyone, and welcome to Unit 6 of our educational series, Stock Investing 101. In this lesson, our intent is to help you understand the fundamentals of financial statements. Today, we have three objectives. First, what are financial statements? Second, what is the purpose of financial statements? Third, the three most common financial statements. So, without any further ado, let's get started. What are financial statements? Financial statements are documents summarizing a company's financial activities and positions. They tell investors about the company's financial health and give a crisp idea about whether the business is worth investing in. Just imagine if you want to keep track of your earnings, expenses, your assets, and your loans. What will you do? You will write it down all the numbers on a piece of paper. Creating and reviewing these numbers can help you make better decisions in your life, such as setting savings goals, creating a budget, and managing debt. Similar way, companies write down all their financial activities on these records. Now that we've covered this, let's explore more on what's the purpose of financial statements. The purpose of financial statements is to assess a company's performance, profitability, and financial stability. Here is a brief overview of the purpose of financial statements for different stakeholders. For example, investors use financial statements to evaluate a company's potential for growth and profitability, and to decide whether or not to invest in the company. Lenders use financial statements to determine a company's ability to repay its debts. Government regulators use financial statements to monitor compliance with accounting and tax regulations. Management uses financial statements to monitor and control the financial performance of the company and to make strategic decisions. Financial statements manifest the company's health status at a specific point in time. Now, let's switch gears and talk about the three most common financial statements. The three most common financial statements are income statement, balance sheet, and cash flow statement. First, let's start with income statement. Income statement tells about the company's revenue, expenses, and profitability over a specific period. It is similar to your personal budget. The main components of the income statement are revenues, cost of goods sold, gross profit, operating expenses, and net income. Revenues are the total amount of money earned by the business from its operations, such as sales revenue. Cost of goods sold, COGS, is the direct costs incurred in producing the products, such as materials, labor, etc. Gross profit is the difference between the company's revenues and its cost of goods sold. Operating expenses are the indirect costs associated with running the business, such as administrative salaries, rent, utilities, marketing, and other general expenses. And the net income is the final profit or loss earned by the company during the period, which is calculated by subtracting all expenses, including taxes, from the company's total revenues. An income statement is usually a tabular form of revenue and expenditure of the company, which shows net income, made or net loss incurred during the year. To understand it more, let us go back to the financials of George's Burger Joint. As you can see, it starts with the total sales revenue of $190,000, which is the money earned from selling products or services. Then, we have the cost of goods sold, or COGS, which is the direct cost of producing those goods or services. In this case, it's $12,000, which represents the cost of raw materials used in the production process. Next, we have the operating expenses, which are the indirect costs of running the business. These include things like rent, electricity, salaries, and equipment. In this example, the total operating expenses add up to $80,000. Now, we can calculate the gross income, which is the difference between the sales revenue and total expenditure. In this case, it's $110,000. After that, we deduct the tax expense, which is the amount of money the business owes to the government based on its taxable income. Suppose the tax is $10,000. Finally, we arrive at the net income, which is the bottom line of the income statement. It represents the profit earned by the business after all the expenses have been deducted. In this example, it's $100,000. So, we can conclude that income statement provides information on how much revenue the company generated, how much it spent to generate that revenue, and whether it made a profit or a loss. Second most important financial statement is a balance sheet. Balance sheet tells about the assets and liabilities of the company. It is similar to your net worth. A balance sheet is a financial statement that provides a snapshot of a company's assets and liabilities at a specific point in time, which means at a specific date. The accounting equation is a basic accounting principle and a fundamental element of the balance sheet. The equation is as follows: assets equals liabilities plus shareholders' equity. Let us understand the balance sheet with the example of George's burger joint. In the asset column, George has cash, inventory, and equipment cost. In the liability column, we have accounts payable and equity. In this example, we can see that the total assets equal the total liabilities and equity. This is because the balance sheet follows the accounting equation stating that assets must equal liabilities plus equity. The third type of statement is the cash flow statement. Cash flow statement tells how much of the actual cash is being generated or spent by the company in a given financial year. It is similar to your checking account statement. The cash flow statement shows a company's inflows and outflows of cash over a specific period. It helps to determine the cash flow position of a business by showing how much cash was generated from operating, investing, and financing activities. The cash flow statement includes information such as cash received from customers, cash paid for expenses, cash received from investments, and cash received from loans. Let's see the burger joint cash flow statement for the year ended 2023. Cash flow statement is divided into three sections: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Starting with the cash flow from operating activities, this section shows how much cash the company generated or used from its operations. For this company, it had net earnings of $110,000, indicating that it made a profit of $110,000 during the year. The company did not have any depreciation expense during the year. Additionally, there were no changes in inventory or accounts payable during the year. However, there was a decrease in tax payable of $10,000. All of these factors combined to give a net cash flow from operating activities of $100,000. Moving on to the cash flow from investing activities, we can see that the company purchased equipment worth $20,000 during the year. This resulted in a net cash flow from investing activities of $20,000. Finally, there was no cash flow from financing activities. In terms of the net increase in cash, the company had a net increase of $80,000. The cash at the beginning of the year were $0, and at the end of the year, they were $80,000. Overall, the cash flow statement provides important information about how much cash the company generated or used during the year and where that cash came from or went. Here is the comparison of all three financial statements. You can pause the video for some time and read all the differences. You can see the actual financial statement data for any company on the SEC website. Let us summarize. Income statement shows a company's revenue, expenses, and net income or loss. Balance sheet shows a company's assets, liabilities, and equity. Cash flow statement shows a company's inflows and outflows of cash over. To make it more simple, you can relate the statements to your personal life example. Income statement is similar to your personal budget. Balance sheet is similar to your net worth. Cash flow statement is similar to your checking account. In this lesson, we covered three objectives. We understood what financial statements are and their purpose. We also explored the three main types of financial statements, uncovering their unique attributes and uses. In the upcoming lesson of this series, we'll dive deep into how to use financial statements to find good investments. We would love to hear your thoughts on financial statements, including whether you use a personal financial statement or not. If you found this lesson helpful, please give it a thumbs up and subscribe to our channel for more valuable insights on investing.